All right, it is June 17th. Today is the first day of the dairy margin coverage enrollment period with the Farm Service Agency. So we just wanted to give you some more information about how to make this decision. There's several webinars available on the website. They're for your use to be able to make a decision and get information out for producers. So first and foremost, what I want to talk about is matching dairy risk with government programs. This presentation almost all covers previous farm bills and the how we got to the dairy margin coverage that we have today. We do not go into the dairy margin coverage itself, as that is a separate presentation. We do touch a little bit on the private risk management options that are available to producers during this presentation. So first and foremost, addressing the need, what conditions have occurred to create variations in government programs over the years. That'll be the bulk of this program, kind of a history type lesson of how did we get here, why do things have the feel and touch that they do. There are several private and public risk management options available to producers, all the way from self-insure, futures and options. Futures and options aren't used much for small dairy farms, especially in Ohio, just because of our size and the bulkiness of it, but very similar to the corn and soybeans markets, futures markets, only for milk production. Obviously, we have the dairy margin coverage, like I mentioned, as a presentation on its own. Partnership through cooperatives for producers. This would be similar to the Dairy Farmers of America and other cooperatives that offer marketing advice to help with milk production, milk pricing. We see the livestock gross margin insurance for dairy. This is very similar to the federal commodity, or this is ran by the Federal Crop Insurance Commission and very similar to crop insurance for corn and soybeans, wheat, other commodities. Then we have the dairy revenue protection, which I'll touch just a little bit on today, that's provided by the American Farm Bureau Association. So we're going to talk about a little bit about what's happening with past policy that has kind of led us to where we are today. So I first want to talk off and start off with, what do strawberries have to do with federal dairy programs? Well, my neighbor, and the answer, my neighbor used to tell me that perception was everything, and that's exactly how this is. One word: perception. Those strawberries I talked about on the previous slide when I was a kid, our neighbors used to have the most beautiful strawberries in the entire world. And we would go over and pick them and eat them. And one day I was trying to grow strawberries for the county fair. I was in 4-H and FFA, and I was trying to grow strawberries for the county fair. And I said, what do you put on these strawberries to make them so good? And they said, well, we add manure and manure and manure. And I said, oh, you should come to our house. We put ice cream on our strawberries. And that's a funny story, but it really comes down to perception. The old margin protection program, MPP, the program that we came out of with the 2014 Farm Bill, was extremely unpopular for dairy producers. The name had to be changed. Anytime you have something that's very unpopular, the first thing you have to do is rebrand it, even though it might look very similar, have the same feel. You have to rebrand it and give it a new name. And so the old margin protection program effectively became the dairy margin coverage program. As you'll learn in the other presentation, the nuts and bolts and mechanics of the program look very similar and are very similar in nature. The second thing is the MPP program was unpopular because it did not provide premiums or money to farmers when they thought it should, and they ended up paying, most farmers and producers ended up paying more into the program than they received back in indemnities. So this new program actually gives refunds for premiums paid to MPP producers, 50% if you take the difference in what you paid in and what you got back in cash. If you take that in cash, physical cash, you get 50% of that difference. Or if you take the difference and apply it to the new dairy margin coverage program, you can get 75%. Federal commodity programs, whether they are dairy or crops, are expenses to taxpayers. This goes into the perception as well. No program is ever free. As my old ag policy professor, Barry Flintball, used to say, there is no such thing as a free lunch. And that definitely comes into play with policy. This is an expense to somebody. And in this case, when money is coming from a welfare system like this, it is coming from taxpayers. And so there are more consumers than there are producers. And so we always have to keep that reality in check, that we just can't go out and give checks and write money all the time. We do realize that there are needs for a safety net in times like what we're in right now, but these are expenses and challenges expenses to taxpayers. And so we have to be cognizant of that as well. Some will say and are saying that there's too much money being allocated to dairy programs right now with all the rebates, the MFP payments that we're getting for the trade aid, this new dairy margin protection program, and others will say it is not enough. And so it really does come down to perception. And that's really why I told this story about strawberries, is I can talk to two people in the same day, side by side, and they would give me a different answer, whether federal commodity safety nets are good or whether they are bad. This increase in dairy margin coverage and helping dairy producers financially is helping right now, but is it enough to keep an operation in business in the long run, in the long term? Probably not. We still have structural issues within the dairy industry. We still have economies this size where big dairies are able to spread those fixed costs over more cows, and their price per cow is lower, or their cost per cow is lower. So we continue to see those cost equations being stronger for larger dairies. And then we'll encourage more production and this drive down milk prices further without increases in demand. And I was taught a long time ago that any safety net ultimately does suppress price, because you're keeping businesses in business and operations in business longer. But it does help in the short term. And the hope is that after a while, we do have an increase in demand that's going to pick up that milk pricing and continue it on moving forward. And so just something to think about as we go through this. So let's talk about the federal dairy programs and market regulations. And we're going to start with 1900 all the way to today. If we think back to the 1900s, we had the dairy pricing schemes, which created higher U.S. prices than the world prices. This encouraged countries to export their product into the U.S. or the U.S. Importers to bring in goods and then sell that milk product on the U.S. market, because we had the higher price than the world price. So it created this flood of imports. We didn't restrict imports, and so we continued to see milk coming into the country that wasn't produced here and sold on the higher price. This remained in place until the 1950s. When we started looking at price fixing and other things that ultimately killed some of the volatility within the markets. Milk processors would also hire dairies in this 1990 or 1900 period. Milk processors would hire dairies in times of short supply, but then when they had too much milk, they fired dairies, and so we had this mix between this flux in the cycle of when do we need milk and how do we access it, and when we have too much milk, how do we move it? And so that created some of the pooled pricing systems that we still have in operation today in terms of these milk marketing orders. Those were largely inspired in the 1990s period as we moved through. So I'm going to start off. The first thing, back in 1900s was this dairy pricing scheme, which created a flat price and pooled prices. In some cases, it was higher than the world price, but it ultimately led to this pooled pricing system that we see here today. We still have. If we look at the federal milk marketing orders in 1937, those are obviously still in place today. They're a revenue pooling system that helps spread that revenue across milk in a region. There's different regions within the United States that milk producers belong to. That came into play in 1937. If we look at 1949, that's when the milk price support program came in. The government would buy milk off the world market to help to support the price and keep the price at a certain level. If the price ever fell so low, the government would just simply buy milk until it got it up to a point. Then we had in 1951, we had the import quotas, which an import quota is when countries are only allowed to send so much milk into the U.S. market. They're restricted on a certain flat rate. It's a limitation for importers and importers in the United States that want milk or end consumers of it. They can only import so much, but also exporters in other countries don't have access to these markets. That's policy stayed in place. Those import quotas stayed in place until 1996. When the U.S. entered the World Trade Organization, we had to make some changes. We'll talk about that in a second. The next period of time was the 1980s when we saw the Dairy Production Stabilization Act. This largely led to some of the changes that we saw in the 70s with higher credit rates, high inflation. And then when those started tanking in the 80s, then the government had to go in and buy milk cows to help decrease production. So that Dairy Production Stabilization Act, that was part of that dairy buyout that the U.S. government engaged with in the 80s. Then, like I said, in 1996, we went off the quota system and we went to import quota tariffs. This is when a certain amount of milk is allowed to come into the United States under the tariff. But then once that quantity is reached, then everything past that is faced with a tax. We still use this system today. If, in some cases, we're not filling those milk quotas in certain places, so those tariffs never come in. That's definitely a case. As long as you're under that quota amount, then you don't have to pay the tariff. It's only when you go over that quota that you have to pay the tariff. If we look back 2002, that's when we had the milk program. It was, again, a revenue program that made payments when income fell too low. So this was on income basis, very different than the Price Stabilization Acts or the price supports that we had in up to 96. That led to the MPP, the Margin Protection Program Dairy, which was, again, a revenue program that made payments when the difference between the feed price and the milk price got to a certain coverage level. Producers were allowed to insure against a certain coverage level, and that was largely what set up today's dairy margin coverage, which is, in my opinion, just an enhanced version of the Margin Protection Program. It allows cheaper coverage levels at higher coverage rates for producers. So let's dive in. If you look at all of this, this is the federal dairy programs over the last 115 years. We've gone through some exhaustive changes. I mean, this is a pretty thorough change from period to period. And so we've seen some major changes in dairy policy that's led. So what are the economic events that led to these policies? Well, again, we're going to look at that Great Depression era back from 1926 to 1937. If you look at that red line there, that is the U.S. milk price, all milk price during that time. And you see right there in the 30s, the start of the Great Depression, the all milk price dropped 42%. This is what led to the establishment of the federal milk marketing orders that are still used today. And you see that black line, that's where the milk marketing orders went into place, largely because of that big drop that we saw back in the early 30s, partially due to the Great Depression, almost all actually due to the Great Depression, but the establishment of federal milk marketing orders that we see today. If we look at the next period, so this is going back after those milk marketing periods. Remember, we had higher price systems, and so we were fighting imports coming in from other countries, getting that higher milk price and effectively, lowering the U.S. milk price. But we see, again, this all milk price in red. During the 1930s and 1940s, we had a parity price system, which was based on the price of milk had to stay the same as a certain formula from a previous year, and in this case, 1946. As taxes and interest rates rose quicker than milk price, that meant that the government had to kick in and raise that milk price up to counter inflation and higher taxes. And so we see the big price spike up in milk prices there in the late 40s. Then that started to slim off as we started to see higher production. Remember, higher prices ultimately usually encourage higher milk production. So we started seeing more and more milk production there in the late 1940s after that price came up. And that's when we enacted the import quotas of 1951, restricting imports coming into the United States, giving them a value that could come in. And we see, again, the price of milk increase going through the 50s. If we look at the period of the 1950s to the 1970s, there was a couple of big issues that really started to spur. We had a milk price support where milk prices were held, at a fixed price that was based on that parity system, but also we had a limited amount of imports. So we were controlling the amount of milk that was coming into the United States at this higher price than the world price, but we were still, faced with margin problems and especially increased feed prices. And so what I've got here is this is the milk price divided by the corn price. The all milk price divided by the U.S. corn price is really what that is. So this is a ratio. And where that line starts diving off, so if it decreases, one of two things could have happened. One, the milk price could have dropped. And you could have saw a reduction in milk price that would lower that line. The second thing is a strong increase in corn prices. And so in this particular case, in the 1970s, we had what was called the Russian grain robbery, where they came into the market and bought a bunch of grain. It sent a price spike of corn and feed grains in the United States way up. And it really suppressed that margin for dairy producers. And so we see a lower margin between the all milk price and the feed price that was really hampering to dairy revenue during that period of time. And so what we ended up with was then this period in the 80s. And again, this is just showing that inflationary period that we were fighting inflation. Again, our parity price system was based on inflation. And so you see this big price inflation starting there in the 70s, plus the higher feed costs that ultimately led then to the collapse of milk prices in the 80s. And that's where we start to see the government coming in saying we need to reduce production of milk. Diane Shoemaker, the state dairy specialist in Ohio, I've heard her say this a couple of times. When milk prices are good, producers increase cows. When milk prices are bad, producers increase cows. And so we needed a way to reduce milk production. And so the government came in and bought dairy cows off the market, which then helped support prices there in the 90s and into the 2000s. So we see that big hump there, which ultimately led to the dairy buyout there in the 80s. The problem that we had also in the 80s was the amount of expenditures in terms of product. And so we needed a way to increase milk price. We were spending a lot of money to buy off these cows, also to buy milk to inflate the price. And so we see this is net dairy purchases of commodities that were then purchased through the Commodity Credit Corporation there in the 80s that led to these high price spikes. When the United States entered the World Trade Organization in 1996, one of the rules that we had to abide to was limiting our government expenditures, limiting that market distortion that we had really built up in the 80s. And so we had to work that down all the way in 96, 97, and 98. We did tick up back a little bit. This was partially related to buying milk and giving it to food banks and other things. But you see a drastic decline from the 80s, largely due to the U.S. entering the World Trade Organization in 1996. So again, this is the all milk price starting in 1986 all the way to the Uruguay trade round, which is when the United States entered the WTO there in 96. And then look at the volatility in milk prices since then. You see big moves, big cycles up and down in milk prices after some pretty constant flat milk prices leading up to 96. So it kind of took the band, I call it a band, off milk prices in 1996. And what we see coming out of this is a new threat of volatility. And I would argue that this is the biggest challenge to the dairy producers, is the volatility. So what this is the change in milk price from one month to the next. As you can see, what I've done here is this goes all the way from 1927 all the way to 2017. And what I've done is I've put two black bands on there when the price spread between a positive 5% or a negative 5% got bigger than those quantities. So if you look in between those two black bars, we stayed within what is a 10% range, positive 5 to negative 5. Outside those black bars, you start seeing bigger and bigger variations in market prices. At 1949 bar, that first bar, that was when we went on the price support program. Under the parity prices, the federal price support program. The second black bar is when the United States went on to the World Trade Organization. We had to get rid of our import quotas. We went to a tariff rate system, and we had to abandon our fixed pricing policy, our parity pricing policy. This then led to the milk program in 2002, which then started the conversation about MPP, which then is now dairy margin coverage. So all of this is geared towards liquidity and helping farmers fight volatility in the market. The other thing it did is when we came off the Uruguay round, very similar to that chart I showed you earlier where we saw big variations. This is a rolling average, so 12 months prior for each of these data points, and you see the cycles within the dairy industry. Now this last cycle we're in is a prolonged cycle starting in 2015 and it's continued. We saw a little increase in the end of 2017, and 2017 was a much better year than 16, but then back down again in 18, and we'll have to see how 2019 shakes out. But we do see these rolling average cycles within dairy prices. So not only do we have increased volatility, but we also see cycles within the dairy market. Again, one of the challenges I would argue that this faces, and I make the case in the dairy margin coverage presentation as well, is that when we look at these prolonged cycles, one of the things that this issues is how do we manage liquidity? as a dairy producer, when we make money, what do we need to do, or what do we do? Well, we buy capital purchases to avoid paying taxes, and so that's what we see with these. We see farmers buying equipment to avoid paying taxes in the up cycles, but then when we have the down cycles, we don't have any cash on hand to pay the bills after a certain point. So finding a way to manage liquidity in this cyclical nature, I think is going to be really important. So challenges to price volatility. Volatility implies prices move around a bunch. That's what volatility means. As we saw in that graph, we see more volatility now than what we did during 1949 to 1996. Traders love volatility because when there's movement in prices, there's money to be made. If there's no movement, there's no money to be made. However, it's a terrible risk management plan for producers of the commodity. We need to be able to manage our liquidity and have some constant revenue, have idea where our prices are going to be down the road. So characteristics of risk management, there's uncertainty, good or bad. To what degree can I predict what the price will be? And this is what I was just talking about. From a dairy producer standpoint, you want to be able to say, I know based on fundamentals where the dairy price is going to be, so I can make decisions today for my risk management plan. Instability or stability, good or bad, prices do or don't change much from one period to the next. Again, this is very similar to the question above, only the question above was being able to predict how certain we were and what the price was going to be. This is more of a constant price. So that fixed price plan that we had from 1949 to 1996 was pretty stable. We didn't see many big changes. And then the last one, inadequacy versus adequacy. Stable or volatile, prices are enough to cover my costs and keep my liquidity ratios intact. This is where I start to think that we need to think about liquidity as a measure of risk management rather than just trying to maximize the price component. We need to think about when can we have cash on hand to pay bills when a down year, when those cycles do happen. That's where I think this is really important. So global markets, how do they impact producers? We were a closed dairy economy until 1996. That's when we had the margin or the import quotas, and we limited the amount of product that was coming into the United States. When we entered the WTO in 1996, we had to go off that, and we imported the import quotas, tariff quota system, where certain amounts are allowed to come into the United States. Anything above that is taxed, but we continue to see product coming into the United States, competing with our U.S. goods. You can't use an old price support system in a global market. If you increase the price supports here in the United States, make the price for dairy prices higher, you will see product and dairy products coming in from other countries and sold on the U.S. market to take advantage of that higher price. Ultimately, what this ends up doing is it doesn't fix the problem that we have for our U.S. dairy producers, and it ends up costing the federal government of the United States a lot of money. And then again, this comes down to the liquidity issue and economies of scale. When times are bad, they're equally bad for everyone. But when times are good, it's a lot better for the large operations, meaning that they're able to make more money when times are good, whereas it's about the same from a liquidity standpoint in those down cycles. So economies of scale are very prevalent in dairy operations. They have been for a long time. I think the new dairy margin coverage program with the strong benefit towards small-scale dairies, I think will be a big help to help mitigate some of these challenges that we see here. So public offering, volatility, mitigation. So again, I've talked about how I think volatility in the market is a big issue for dairy producers. What I've done here is this red line represents the margin between milk price and feed costs from 2000 and 2019. If you look there, the average margin between the milk price and then the all feed costs was $8.24. So that was the average over this time period. The old MPP program had a top coverage level of $8. So that meant the majority of the time, because average was $8.24 and the top coverage level was $8. So that meant the majority of the time, that margin was below $8. Or excuse me, above $8. The margin was above $8, and so and that's what pulled the average up. It was above $8, and so it was not falling below. Producers weren't able to mitigate some of their volatility and liquidity within the program. Let's talk about dairy revenue protection real quick. Again, this is the private insurance product that is being put out and ran by the American Farm Bureau. It's a private insurance product very similar to the crop insurance program, only for milk. It's available everywhere in the United States, and it's traded every single trading day, which is almost every day when the market is open, but the market does close at certain points, and so you can't trade at those points as well. It's a revenue protection program, and so it is protecting against price times quantity. The price is based on the federal milk marketing order prices. It can be just on fluid milk prices, which is class 3 or class 4. Remember that class 1 and class 2 are solids or butter. And then which quantity? Whatever coverage level you as the producer choose, it is assumed that the production risk is similar to state level changes in milk production or milk production per cow. And so that's kind of the assumption. If you have really high production per cow, you're going to want to look at this a little bit differently than somebody else based on that quantity value. It is a quarterly program, not monthly. So the Dairy Margin Protection Program provided under the Farm Bill is a monthly program. This is a quarterly program. And if we look at how it fits onto the risk scale, again, these are 801s all the way to 808s for policy. You can hedge out 5 quarters. And so what I've got available here is the red squares are when the policy is available. The purple square is when it is not. And so this is a matrix. And so if you're sitting there in that top bar, July 1st through September 15th, the first quarter that you can buy this production for is that quarter running from October to December. But you can also go all the way out to October to December of 2019. Now, the way this, and so the next year, if you were in September 16 and December 15, so that next quarter, the earliest you can buy coverage would be January to March of 2019, but you can go all the way to October to December of 2019 as well. So again, it's based on a quarterly, January to March of 2020. I apologize for that. You can go out 5 quarters when you start. The benefit to this, or the strategy here, would be to hedge a long way out, go 5 quarters out. You can only go 5 quarters out, but I would encourage you to go 5 quarters out, and that's what I'm representing here. I give credit to the University of Minnesota, some economists up there that put this together. But this is for a producer. The green bars is when this program is making indemnities or insurance. The gray bars is revenue for that margin, and these are milk prices. And so you see the green bar when it is triggered. This is only if you go out 1 quarter. This is if you go out 5 quarters. So again, there is some benefit to filling in the gaps by going out long distance, going out 5 quarters and hedging at high coverage levels or high percentages of your milk production. So just a summary real quick. Dairy policy has gone through major reforms since the first policies in the 1930s and even really the 1900s. They are likely to go through many more changes until dairy policy finds a way to help producers manage liquidity instead of measuring profit. I think this is really important and mostly the biggest challenge facing dairy producers today. There's a disconnect between what is needed and what is provided, although I do think the new Dairy Margin Protection Program helps find a sweet spot for producers that they're able to help manage some of their risk a little bit better with that margin between all milk price and feed costs. There are 2 major challenges. Dairy producers feel like they're always victims of large price volatility. We saw that. We know that since 1996, the price volatility has picked up. I showed you that in that one chart. And then larger farms have historically handled the cycles better than others. Remember, all farms tend to have bad years about the same, but in good years, large farms tend to have more equity on hand and capital to fight those down cycles. And that might sound trivial, but I just want you to think about, if we were to look at returns per cow, they're roughly the same in a down year for a big farm and a small farm. But in big years, those returns per cow are a lot bigger for the bigger farms than they are for the smaller farms. The old MPP program and the new Dairy Margin Coverage Program might have found a sweet spot by providing the MPP has the same thought as DMC, but with less money. So the dairy margin coverage program has more money, able to trigger payments more frequently and provide more coverage, again, at $950 instead of stopping at $850 coverage levels. The subsidies for premiums are significantly tailored towards smaller scale operations at tier 1 production, less than 5 million pounds. When you get over 5 million pounds, the premiums go up pretty significantly, especially over $5. And then price and revenue risk, that insurance program I talked about, but also futures and options and other sources of private risk coverage are well suited for large-sized operations the best. So with that, I want to give thanks to the people I referenced in this presentation. This work was sponsored by a grant from the North Central Extension Risk Management Association, which is a partnership with the United States Department of Agriculture, USDA NIFA. So we thank them for their partnership with us in this project, and we look forward to seeing you around the state of Ohio soon. Thanks.